it's the foundation. You need to get this nailed on. Literally just to make sure you're pretty much always, more times than not, trading on the right side of the market. And that is what market structure is going to allow you to do. So we're going to really dive deep in this module. We're going to make sure that you've got it absolutely nailed down before you kind of start to bring in the other concepts such as supply and demand and liquidity, etc. Because market structure is what matters and everything else is what slots into that. Okay. So, what actually is market structure? Well, essentially all it is the highs and lows in a market, which we then map to essentially, make sense of it all. So kind of want to bring your attention to where we're going to start off in the top left-hand corner. And here we have what we call bullish market structure. In more simple terms, it's an uptrend. Okay. So imagine prices moving nice and uniformly to the upside, right? So we get what's called a higher high, which is what I denote here with the HH. So we get a higher high, price then pulls back, okay? And then it starts to move to the upside again. So obviously as we break past that high there, we now have a higher high, which is again, why we have this annotated here, okay? So we have a higher high. Now a boss is just simply, it stands for break of structure. Okay, and that's what I said. What is structure? Structure is simply just the highs and lows in a market. So in this instance, price initially moved up, it formed a higher high, price then pulled back. And then when we broke this high here, right? So we get a break of structure, a boss, we then form a higher high, okay? Now, it's only at the moment that we get that break of structure. So at this exact moment here, where we break the previous high, the current active high at that moment, it's only when this break of structure happens that we actually know where the high low is, okay? So the reason why that is because what could have happened, right, is price could have pulled back, it could have started to move up, and then some people, wrongly in my opinion, would label that as the high low, but you don't know that that's the high low just yet because price could come back down first and break it before then going up, okay? So the previous low is down here. It's only confirmed as the new high low once we get that break of structure. Okay, so then we break that high, we get a boss, and we form a higher high. Okay, price then starts to pull back. Okay, and at the moment, this is still the current high low. Okay, it's only once we get what? It's only once we get that next break of structure at that moment where we break the prior high to form a higher high. That's when we can look back and then we know where the high low is. Okay, because this becomes a high low only once we get the break of structure. So then this is no longer the high low. This becomes the high low. Okay. So a bullish market is very simply defined as price making higher highs, higher lows, the higher high, higher low is confirmed once that break of structure happens, right? And then we get the higher high, and again, so on and so forth. And overall, that series of higher highs and higher lows, that whole movement there, that is what we call the bullish trend, okay? That bullish run is made up of a series of higher highs and higher lows. And then the exact same for a downtrend, which is what we call a bearish market structure. It's the exact opposite, right? So we get a series of lower lows, right? And then price pulls back to form a lower high, but we don't know where that lower high is going to be until we actually get that break of structure. That then confirms where the lower high is, okay? So we know where the lower low is when price starts to pull back. We draw our boss line across, and then once price breaks it, then we look back and we see, okay, this is where the lower high is, right? So a bearish market is a series of lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, and so on and so forth. And overall, that series of lower lows and lower highs makes up a bearish trend. Okay, so that would be if the market moved in those nice, very simple, straight lines like this. But obviously, in reality, it can often be a little bit more complex. So here's a bit more of a slightly realistic example where initially we have a nice higher high, right? We pull back, and then once we break that high to form a higher high. After that break of structure, we can look back and see that is where the higher low is, okay? Now, a bit more realistic in the market, we'll have, a bit more complex price action where we'll see price doing all of this, right? And then it pulls down, and it pulls up, and it pulls down, and it pulls up, and it pulls down, and then it finally breaks the high, right? To form a higher high, okay? So in this instance, it might be quite easy. Obviously, I've already labeled it, but this is where the higher low is, okay? The problem is a lot of people in the market, they will label, or they're not sure, right? They go, where is the low? Was this the low? Is this a swing low? Is this a swing low? They don't know what where exactly it is. So what I kind of should have said as well is at the moment we're referring to this as swing structure. Okay, so these are the big swings in the market, the big obvious turning points, right? So for our definition, when we have a bullish market, okay, or in any market, the swing high is the highest point that causes a swing low, and the swing low is the lowest point that causes a swing high. Okay, so in a bullish market, we always know where the swing high is, right? When price starts to give that significant pullback. But once we get that break of structure over here at this moment, okay, and we want to know what current range are we within, where is our swing low? Well, what is a swing low? A swing low is the lowest point that caused the swing high. So at this moment here, when price breaks the high, okay, at this exact moment, and we look back and we want to know where is the swing low, well, what is it? It's the lowest point that caused the swing high. So this was the swing high, right? After it's broken, we look back, and between that swing high here where it formed and between where it broke, where is the lowest point in this box? It's obviously here, right? So that's why that becomes our swing low. So when we break that high and we form a higher high, that becomes our high and that becomes our low. So then at that moment, between these two orange lines, that is our new current swing range that price is trading within. Okay, this is our swing high, so price can pull back, right? And then that is the swing range we're within. So it can do whatever it wants, right? It can pull all the way down here, but until, as long as this high low stays intact, if price doesn't break it, then we go up and we get that next break of structure, right? That then becomes our new high low there. So yeah, that's literally it. Now the problem is what will happen if I zoom in a little bit into here, is if you don't get your swing structure mapped correctly, you can find yourself on the wrong side of the market. Okay, so what I mean by that is imagine, right, you were really zoomed into price and you were only looking at this price action that I've circled from within here. Well, then you could be forgiven for thinking, well, price is making lower low, lower high, lower low, right? We pull back up to form that lower high and a lower low, right? If you're only looking at this section of price action. So then you think, okay, well, I want to get short from here because if it's a bearish market, right, then price should come up into here and it should continue to the downside because that's what we would expect. But you end up getting smashed, you end up taking loads of losses, and you're sitting, there scratching your head thinking, why am I taking losses here? I thought the trend was bearish. I keep seeming, getting stopped out. And the reason why is because you haven't zoomed out enough to actually see where we are within the true swing structure, okay? Because at this moment, this is your swing high and this is your swing low, okay? Because we are bullish. So all of this that you're trying to sell within here, this is just the internal structure. Everything between the swing high and the current swing low at that time, this is all just internal structure. So all of this can do whatever it wants, right? This whole time it can break highs, it can break lows, but as long as it's between the swing high and the swing low, the market is bullish. The swing trend is bullish, okay? So that's why, although price can be doing this and you could be seeing, this moving to the downside in the middle, you have to understand that the swing trend is bullish overall, okay? And obviously, again, once we get that break of structure, we look back at the lowest point, that becomes our new high low. And now you're playing within this range. So again, price can pull back and it can do whatever it wants. It can break these lows. It can come down like this. It can start to move to the upside. But until it breaks either the high or the low, right? The market trend is still bullish. The swing trend is still bullish. And the expectation, right, is that we're going to continue to get a higher high, pull back to form that higher low, and continue to get that higher high, okay? So just resize this a little bit. So exact same thing applies for, bearish market structure, where essentially, again, right, we have a lower low, lower high, we break that structure. So at this moment, this becomes the swing high, okay, that orange line, we're within that swing trend, and this becomes our current swing low. So price can do whatever it wants between those orange lines, but at this point, the swing trend is bearish, right, until price breaks that high, okay? Otherwise, we are still bearish, okay? So price can do whatever it wants, and then it's only once we then go on and break that swing low to form a swing lower low, then we can look back and go, where is the new swing high? Well, it's the highest point that took out this low, right, after it was printed, which would be this point here, okay? This is the swing high. So then you draw your new swing range, okay, between these two orange lines. And again, price can do whatever it wants. It can pull back, it can break this high, it can break this high, but it doesn't matter. The swing trend is still bearish, okay, because it has not broken the swing high. So as long as we're trading between the swing high and that swing low, okay, we are still bearish no matter what it does in between. That's all just internal structure. And that's the thing, right? Because people don't have this framework, they'll sometimes see like price break this high. They think, okay, now we're bullish, now we're going to the moon. But no, that's not swing structure. The swing structure is the previous point, highest point that broke the previous swing low. Now you know what new swing range you're within. So whenever you're on the live charts, again, we're going to practice this loads, but we will always map out the current swing range we're within. So we're always aware whether price is bullish or bearish with the swing structure. And therefore we always know that we're expecting at any moment that lower high could form to then come down and form that lower low. Okay, cool. Now, the one thing I probably didn't say, but it is super, super key, and this is going to seem probably very, very basic at this moment, but I guarantee you, if you can remember this in the live market, like you have to keep reminding yourself every day, it will help you honestly stay out of so many potential losing positions when obviously in the live market things can get a little bit more complex. And all that simply is after a break of structure, we expect a pullback on that time frame. Okay, so everything we're going to be doing so far is all in one time frame for quite a lot of lessons now. We'll do multi-time frame analysis towards the end. So everything for now, just think about one time frame. Okay, so after a break of structure, we expect the pullback on that time frame. So what does that mean? Well, after we break that high and we form a higher high, or we break that high, price can go for quite a while. But at the moment we get that break of structure, you have to start thinking about at any moment that swing pullback could be kicking in. Okay. So again, once we get that break of structure here, yes, it could keep going for a while and you could keep buying, but you need to be a lot more like quicker with the targets, because at any moment after that break of structure, we're expecting that pullback. Okay. And again, this is where a lot of people go wrong in their trading, because they see that break of structure and they go, oh, now we're strong. Now we're breaking highs. Now we're going to the moon, and they keep buying. Then what happens? Then price pulls back because we expect the swing pullback. They don't, and they get stopped out or their profits go away. Okay. So where we want to be buying is we want to be buying here. We want to be trying to catch these high lows and we want to be targeting these highs. And that's when we want to then be taking profits, then waiting for the pullback. We can also trade the pullback as well, but wait for that. And then we want to be catching this and we want to be targeting here. Again, taking nearly, or if not all of our profits, and then waiting for the pullback. Whereas losing traders, they're waiting for the break, then they're buying up here, and then they're always getting stopped out or not making a lot of returns. Okay. So super, super key. After a break of structure, that's when your mind needs to start thinking and saying to yourself, okay, at some point now, we've had a break of structure on this time frame, we can expect a swing pullback on said time frame. Now, we're going to look at basically the exact same thing, but we're just going to add in a concept of what we call strong and weak highs and lows. Now, this is what I think is a reasonably simple concept, but it is so underratedly powerful that I can almost go out on a limb here and say that the entire strategy that we use is pretty much based on this concept. And what we essentially want to be doing is we want to be trading from strong structure and we want to be targeting weak structure. Okay. And that is literally it. If I could boil down the strategy into the most simple philosophy behind it, is we want to be trading from strong structure. Okay. And we want to be targeting weak structure. Okay, so let's go through that and you'll see exactly what I mean. So remember, nice simple bullish market, we get a series of higher highs and higher lows when we break that structure, right? Higher high, higher low, higher high, higher low, higher high. Now, the way to think about this in a bullish market is that when price pulls back like this and then price goes up and breaks it, it takes a fair amount of money to break these key structural points in the market, right? Because there's going to be, people who have sold here. There's going to be people who, are going to want to, protect their position. So, an even more simple way to think about it is, what is a high or a low's job? Well, a low's job, so a low, its job is to try and make a new high, okay? And then you could say a high's job over here is to try and make a new low. So a high is always trying to make a high is always trying to make a low, and a low is always trying to make a high, right? So if this low goes on to make that higher high, right, it takes a lot of money to break structure to the upside. So now this becomes a strong low, which is what we use with this solid line, okay? So when price comes back down to it, you can kind of think about this becomes a protected low. So we can use the words strong and protected. They mean the same thing, okay? And the reason why you might want to call it protected, if this kind of helps you understand it, is you could go, well, big money stepped in to move the market to the upside, right? To break these highs. So as price is coming back down, you could think that there's a vested interest to want to protect this low. They're not going to want price to come down and break past it, right? Because then obviously they're going to lose money or lose their profits. So if a low breaks structure, it becomes a strong low. So when price is pulling back, the expectation is that strong low will not be broken, okay? And then that's why then price moves to the upside again. This low holds, right? And then we get another strong high low, right? Because that low breaks structure, right? So that's why in a bullish market, you continue to see each strong low hold and it doesn't break. Price pulls back near it, but as long as it holds, it's still a strong low and it moves to the upside, okay? So in a bullish market, you have strong lows, and that's why we want to be buying from the strong higher lows, okay? And that's why I was saying the whole idea of the strategy is we want to be catching these movements. We want to be trading from these strong lows, okay? So as price is pulling back and we're in this current swing range, and we know that this is the strong low because it broke the high, it broke structure, right? All a strong lower high is it's one if it broke structure. That's a more simple definition. So a strong low is strong if it breaks structure. So when price is in this swing range and price is coming back, we know we want to be buying as price is coming near this low because there is a high probability, not guarantee, but high probability that this low will be protected and price is going to want to continue to the upside, okay? So what is the other side of that? Well, why do we have these dotted lines here? Well, in a bullish market, the highs are weak. Well, why are they weak? Well, if you think about it, what is its job? It's only strong if it breaks structure. But as price is moving back, right, this high, we're not, the expectation is that this low is going to hold and it's not going to break. So this is a weak high. So as price is coming up to it, right, and we can see that it hasn't broken any structure, the expectation is that it will break. Again, same price pulls back, but it fails to break the low, right? This high here does not break this low. So it's a weak high. So we expect what? We expect it to break. We expect in a bullish market that the strong lows will hold and the weak highs will be targeted, okay? And again, that's what the whole philosophy is. The expectation is that strong structure will hold and weak structure will be broken, it will be targeted. And that's why in a bullish market, we see these strong lows hold, weak target the weak high, right? We pull back in this swing range, we expect the strong low to hold, target the weak high. Okay, but now we're in this new swing range, right? We expect this low to hold, price should pull back, but it won't break it. And then we can now get long, try and get long and target the weak high. Okay, so on and so forth. And it's the exact opposite for bearish structure, right? We pull back, we come down. Now this high breaks this low, so it's a strong high. So we're now currently in this range, right? Price is pulling back. The expectation is, right, that in a bearish market, what do we expect? We expect price to keep making lower highs. So if this is the current high, what's the expectation? The expectation is price will not break it because we're expecting a lower high to form. And also because it's a strong structure. Why is it strong? It's strong because it broke this low. It caused a break of structure. That's why it's a strong high, okay? It's a high that caused a low, right? And that's why in a bearish market, those strong structure is protected. It doesn't break. And we see that series of lower lows and lower highs, right? And the lows are weak because they don't break any structure to the upside. So that's why they keep being targeted. And we protect the highs. And that's kind of as simple as it needs to be, but it's a super, super powerful concept when you combine it with everything we're going to use. So again, higher highs, higher lows, we break that high. This is the new current swing range. So price can do whatever it wants in between, right? Remember, but we just expect that this strong low is going to be protected because it broke structure. So we know there's a lot of money that has a vested interest, let's say, to keep this low protected. So price can come all the way down. It can literally have a double bottom, but as long as it doesn't break it, then the structure is still bullish. This low is still strong, it's still intact, and this high is weak because it hasn't broken anything. So now we can try and look to catch this new high low to target what? Target the weak structure. We always want to be buying from strong lows and we want to be targeting weak highs. Same thing from here, right? If it's bearish, we want to be selling from the strong high, right? So we want to be trying to catch this move. We want to be selling near this strong high. And what do we want to target? We want to target this weak low here. Why is this low weak? Well, it failed to break structure. It didn't break any structure to the upside. So we want to trade from, i.e. sell from strong structure, and we want to target the weak structure. Okay, hopefully I've kind of made my point nice and clear here, but watch it as many times as you need, and hopefully it will become as clear with time. So, like I said, right, strong low is a low that causes a high. So this is a strong low because it breaks structure. It causes a high. So that's why price doesn't break it. Of course, sometimes it will. We'll get onto that in a minute. But the expectation, it's a framework that we use, okay, to help us with probabilities in the market. That's how you have to think about it. And a strong high is the opposite. A strong high is a high that causes a low. So again, if you want to keep it nice and simple in your head, strong structure, highs or lows that break structure, okay? It needs to have broken structure for it to be strong structure. And if it hasn't broken anything, then it's weak, okay? Because it failed to break structure. Now, typically in a market, we will see these swing highs and lows, the strong ones, right? They usually form with a sharp move away. So typically what you'll see is price will move down and then be kind of slow and corrective. And then usually where the big money steps in, you usually see quite a sharp and obvious move, okay? Doesn't have to be a rule, it's just something you typically notice, okay? So it can be quite easy to see in the eye. So again, this is kind of the strategy, right? Our goal is to catch higher lows. Why do we want to catch higher lows? Well, in a bullish market, the higher lows are the strong structure. This is what we're trying to buy, okay? They're going to be the highest probability moves because we're trading with the trend. We're buying from strong structure here and we're targeting the weak structure. So that's why our goal is to catch higher lows. And then our other goal is to catch the lower highs, right? Because these are the lower highs. We're selling the strong structure and we're targeting the weak structure. So all that line means is we're following the trend and we're trading from strong structure and we're targeting weak structure, okay? Cool. So the final kind of, I guess, key little lesson we want to do here with the basic market structure lesson is look at trend changes, because obviously so far all we looked at was just bullish market structure on its own, and then we looked at bearish market structure on its own. Now, if you trade Forex, which you probably most likely are going to be, the market doesn't tend to trend in just one direction for a very, very long time, like sometimes it can do in, say, equities, stocks, right? Or potentially even the crypto market. We tend to get a lot more trend changes and a lot more sort of overall bigger ranges, okay? So very, very simple concept, but there's some nice mechanical frameworks to think about this, especially when the market gets a little bit more complex. So you have to really make sure you nail it down now, okay? So we have a bullish market initially. Why is it bullish? Well, price is making a series of higher highs and higher lows. So we get the higher high, price pulls back, okay? It's only once we get the break of structure that we can then look back and know where the higher low is, right? So then this becomes our new swing range. Then we start to pull back. So we know that this is our higher high, and then we can draw from the high across and we draw from the low across. And then between these two orange lines, we know that this is our swing range, okay? So what do we expect at this moment when price is pulling back? Well, we're not surprised that price is pulling back because, again, remember another rule. When we get a break of structure, what do we expect? We expect a pullback on this time frame. So after that break of structure, price starts to pull back. We can then label that as our higher high, right, as price pulls back. But what are we expecting? Well, we know that we have a strong low here. Why is this a strong low? It's a strong low because it broke structure, okay? So the expectation is that price will pull back, but it won't break this low, right? Because it's a strong low, and we're expecting at some point the new higher low is going to form and break this high to form a higher high. Right? And that's essentially what the frameworks that we're using so far, right, to trade that bullish market. Higher highs, higher lows with weak highs and strong lows, right? Again, pull back and break structure to the upside, okay? So after a break of structure, what do you expect? We expect that swing pullback on that time frame, okay? Now, at this moment where the orange line is, what would be the expectation? Because obviously we wouldn't be able to see in the future if we were looking at the live market. What would we be expecting? Well, this was a strong low because it broke structure. It formed a higher high. So the expectation would be that this low is strong, it's not going to break, and price will not trade below here. That would be the expectation. But obviously the trend is not just going to go in one direction forever. At some point that trend may change. So if price then comes down and breaks the strong low to form a lower low, now we have a bearish trend change, a shift in market structure from bullish, right, now to bearish, because we now have a lower low, right? The series of higher lows has now been broken to form a lower low. So for me, and what I would recommend, how I use it in Photon, is the moment we get that first break of structure,